It's nothing. Yes.
Ok. J'attends un peu? Ouais. So 2 minutes left. Faut carrément que... Pas les micros. Merci. Ouais. Okay, so the room should be a bit more plenty after a couple of minutes, but let's start. So I'm Emilie Rieupeyroux. I work at Euronext, the market infrastructure operator, and I'm delighted to be with you today. As you may know, Euronext is a core supporter of Institut Louis Bachelier, so it's a pleasure to be with you. Long story short, because it's always difficult to introduce someone who is so well known in the industry, and I mean it, I'm blushing. I'm really glad to welcome David Hirshleifer on this keynote speak. So, as you may know, David Hirshleifer, and sorry for the pronunciation, has been a very core innovator, I would say, in the research field by building links between academic fields that were not necessarily related in the first place, typically finance, mathematical finance, shall I say, and psychology, and enabling us to really better understand investors' choice, market outcomes for investors, everything that really matters at the end of the day when it comes to understanding how financial markets operate and how they can serve or not investors' best interest. And so, indeed, in terms of background, and I'm sorry, Professor, because I will not be able to go through such a long curriculum and impressive curriculum, but basically, Professor Hirshleifer is a Robert G. Kirby Chair of Behavioral Finance. He's a fellow and former president of the American Finance Association and an associate of the National Bureau of Economic Research. He's been an influential editor in many financial journals. And he began his academic journey in mathematics with a BA in UCLA, followed by a master and a PhD in University of Chicago. He has received multiple recognitions, including the Smith-Breeden Award. And during this keynote, he will drive us through his latest paper, which focuses on the diffusion of social networks news and market reactions. So I'm really glad to welcome you on stage, Professor Hirshleifer.
Thank you so much, Marie, for your very gracious introduction. It's my pleasure and great honor to be here. I'm just delighted, and thank you also, Marie, for having me here. So I'll be presenting a paper and talking about the context of this paper, which the more broader context is about social economics and finance, which is a field that I have been obsessed with for the last decade at least. And so this is illustrated by this quotation from Robert Shiller, who has been a great pioneer in this nascent field. And he talked about how investing is a social activity, and investors spend a substantial part of their leisure time discussing investments, reading about investments, or gossiping about others' successes or failures in investing. So the point of all this is that finance has traditionally been an asocial field. That is, people form their beliefs, they make their decisions without interaction with others, except for a very specialized kind of interaction, which is where people place orders on usually impersonal orders on financial markets. But in traditional finance theory, people don't talk to each other. They don't observe each other's behaviors directly. So basically, they just observe market price or maybe market price and market volume. But apart from those very specialized market social interactions, there's no other social interaction. Now, in practice, it seems that people actually talk to each other, as Shiller emphasized. That has a really big influence about how they think about investing, certainly for retail investors, but I think also for professional investors as well. And so even behavioral finance, which takes into account that people are imperfectly rational, that psychology matters, it still is taken as individual level biases. Great. Tell me if I make an indication if I get too loud or too soft. So there are still, the biases are still hardwired into the individual rather than something that people acquire by interacting with others. And so, for example, if we think about the tendency to trade based on trends, okay, then even in behavioral finance models, you can allow for people who trade based on price trends, but that's just assumed to be the characteristic of the individual, as compared with reading or talking to people and learning to trade based on trends, which I think is what most people actually do who are trend traders. They acquire this idea from other people. Or take the opposite idea of being a contrarian trader. Well, I think a lot of investors hear the phrase buy on the dips, and so then they start trading against price movements. It's not that it's hardwired, and indeed this behavior of being a trend chaser versus a contrarian trader, this can systematically vary over time, and this can contribute to the rise of bubbles. So market bubbles, instead of being something that any single investor individually would create, is inherently a social phenomenon that arises from people interacting either directly in person or through social media or through traditional media. So market bubbles are an example of an emergent phenomenon that if you took just one investor, probably that investor is not going to go wild, buy like crazy, and then later sell off. And if there were no other investors to invest in, or if we think about one representative investor, and then everyone else is just like this investor. So we take that investor, multiply her by 1 million investors who are exactly the same, then it seems unlikely that that investor would buy like crazy. In fact, if everyone is the same, they can't all buy. The markets wouldn't clear. And that they're not all going to buy like crazy, drive up the price, and then at some point all decide at the same time for no particular reason, you know, prospects for Tesla are not as good as I thought, and then the price goes back down. It seems more plausible that bubbles are a social phenomenon where people are talking to each other, and one person becomes optimistic and talks to another and spreads that optimistic idea to the other, and maybe there's a self-reinforcing positive feedback effect, so for a while prices shoot up too high until the arrival of disappointing news triggers a sell-off. So this is an example of an emergent phenomenon where the behavior of the aggregate can't instantly be seen just by taking the behavior of any single individual, multiplying it by n, the size of the population, to describe what the aggregate is going to do. So this understanding of how aggregates behave as distinct from simply scaling up how individuals behave is a major part of what social finance studies. So in this paper in particular, we're looking at the idea that social interactions affect investment decisions of both retail and professional investors. And there's growing evidence of such social influence in investing. And there are different ways in which social interaction can affect how people invest. One thing is very positive. It can disseminate valuable information and improve decisions. And there are several models of this, let's say, quite traditional idea of information aggregation. On the other hand, on the dark side, social learning or social influence could propagate incorrect beliefs or naive trading strategies. So there could be that someone has some crazy idea about a meme stock, and then that gets spread to other investors through social media, such as Reddit and Wall Street Bets. And then there could also be informational free riding and information cascades. There are biases in the transmission of information. So if systematically, for example, favorable information gets transmitted more than unfavorable information, that will clearly tend to promote bubbles. And that will tend to promote bubbles in a way that's different from just an individual level psychological bias to be over-optimistic versus over-pessimistic, for example. Instead, it's something that affects the dynamics of price movements through the transmission bias. For example, if we have just a few optimists, that's going to lead to only a slow rate of increase in overpricing because there are only a few spreaders who are spreading the over-optimism, whereas if we have many optimists, then they're going to spread that to a whole lot of people, and so the bubble will tend to grow more quickly. And so this will lead to some kind of dynamics of bubble formation as the fraction of people who are over-optimistic shifts over time. So again, the social finance sort of way of modeling things is going to lead to dynamics which is different from just thinking about a behavioral economics, a behavioral finance bias taken in isolation. So let's see. So we study here how, in particular, how social networks influence the dissemination of a particular kind of news, earnings news. So here, another central concept in social economics and finance is the idea of social networks. That is that there's some kind of linkage structure. Some people are more connected to each other, they're interacting with others, and they are less connected to others. And through understanding the structure of social connections, we can then understand how financial ideas and behaviors and information spread. So in the modern era of social media, we can actually measure social networks. We can see who is connected to whom, and that brings this to implementable ideas that can be measured about how financial behavior is spread. So the other part is dissemination of earnings news. So I'd say what's more specific to this paper as compared with, say, any other social finance paper is that we're looking at the idea that a public information signal, namely an earnings surprise or earnings announcement, that is not just absorbed by the market all at once, right? Traditional efficient markets theory, it's the earnings announcement is made, it's public information, everyone incorporates it at the same time, and there's nothing to be learned thereafter. So instead, our thought is that some investors are immediately paying attention to the earnings surprise. Some investors may not immediately fully incorporate it, especially retail investors. So I'd say for most firms and most retail investors, usually retail investors are not paying attention to the earnings announcement of any particular firm immediately, but they might later if someone tells them about that firm and tells them about the good or bad news. Some evidence which fits squarely within traditional behavioral finance is the post-earnings announcement drift anomaly, which is that prices fail to swiftly incorporate this public information in earnings surprises. So when there's a positive earnings surprise, on average the price jumps, but it seems to not jump enough because in the 9 months thereafter, on average the stock overperforms, post-earnings announcement drift. And after bad news, the price drops, but on average, the stock return continues to underperform. Okay, and behavioral finance can already explain this by saying that investors have limited attention. And so some investors are not paying attention to that earnings announcement, and therefore their beliefs don't go up enough after good news, and their beliefs do not decline enough after bad news, leading to this predictability in stock returns after earnings announcements. And so what we're interested in then is, based on the social network, then can that accelerate the incorporation of earnings news immediately and thereby reducing the later post-earnings announcement drift, or maybe it would decelerate it so that you get a more sluggish immediate price reaction and greater post-earnings announcement drift. By the way, if there are any questions or comments along the way, please stop me. I think that's more fun that way. So again, our conceptual framework is that not all investors are immediately attentive to earnings news. And in particular, our key further assumption is that local investors tend to pay more attention to the earnings news of locally based stocks. So if we take a stock that's headquartered in the same county where the investor is located, local investors find local firms highly salient. There's a tremendous amount of evidence that local investors invest disproportionately in local firms. So this is called local bias in investing. And so we're taking that further to say they pay more attention to such firms. And so we suggest that they're going to pay more attention to the earnings announcements of those firms. They will tend to be the first people to pay attention. And then the earnings news spreads through the social network to other investors through social connections. So if we start with the county where the firm is headquartered, then if another county is heavily socially linked to that county, then the earnings news tends to spread to that next county, and people start trading on the earnings news early. If there's another county connected to that, the news moves on to the next county, and so on. So the counties that are most socially connected to the network county get influenced by the earnings news soonest. And that has a further implication, which is that if you have a location which is highly central in the social network, meaning that many counties are socially connected to that first county, and the firm is based in that highly central network, then earnings news is going to be disseminated through the social network of investors more rapidly. Therefore, in response to an earnings surprise, let's say good news, the price will react more quickly to that news, and there will be less stock return predictability. There will be less post-earnings announcement drift. Instead, if you have a socially disconnected county where very few counties are strongly socially connected with it, then the price response to the earnings news is going to be sluggish, and you're going to have stronger return predictability. The broad idea then is that social interactions are shaping investors' beliefs, trading, and prices in this particular way. So we measure the social network of investors using Facebook data for our primary tests, but we go on to use a different social network, social media platform, StockTwits, where we obtain similar results or compatible results. What we find with the Facebook data is that announcements by firms in high centrality locations trigger immediately greater price response to earnings news, as I've just suggested. Also greater price volatility after the earnings announcement event, which is immediately consistent, same idea that in response to the earnings news, there are faster price responses immediately. There's also immediately a greater volume response. So people are trading more heavily in response to the news in a heavily socially connected, in response to news for firms that are located in more heavily socially connected locations. Okay, so after the announcement, we have weaker price drift. So the news is being incorporated more rapidly for the highly socially connected firms, and that means that there's less need for later correction with the post-earnings announcement drift. There's also faster decline in return volatility. So the return volatility is high near the announcement date because the news is coming in, but then you have extra volatility to the extent that that news wasn't immediately incorporated into price. And so that's the later volatility, but that later volatility will fall off more quickly to the extent that the news gets incorporated already early on. So in the more socially connected, for the firms that are in more socially connected locations, the volatility declines more rapidly. But, and here's the surprise, is that the volume, it does not decay more quickly. The volume of trade is actually more persistent when the firm is more socially connected. So this is something that needs further explanation, which we will get to. I'll observe that traditional models fail to explain this pattern. So traditional models would say, okay, we incorporate information quickly, then we're going to have a faster decline in both volatility and also volume of trade. So we provide a framework for understanding these patterns, which is based on the idea that there's social transmission of news, And as this news is transmitted through the social network, it attracts investor attention to the news in more and more locations. And there are discussions of the stock that had the news, and those continue to influence investor beliefs even if no new information is arriving in the market, right? So these discussions between investors are very important for these, in our conceptual framework, are very important for understanding the dynamics of trading and of price movements. And in particular, you get fluctuations and disagreement between investors causing excessive trading. So let's say there's good news. Some investors pay attention. Their beliefs are going to become more optimistic relative to the investors who are not yet paying attention to the good news. And that induces disagreement. Now, as investors talk to each other, that disagreement is fluctuating. So some investors who haven't got the information yet, they disagree with those. But as they get the information, they come into agreement with the investors who did get the news. And so you have fluctuations and disagreement, and this leads to excessive trading. And in particular, it can lead to what we call social churning, which is where stocks are changing hands back and forth as the beliefs are shifting through the transmission of information. So this can provide a unified explanation for the dynamics of return volatility and volume. We also provide direct evidence on the communication between different investors, the shifts in their attention, the shifts in their disagreement, and their trading by looking at StockTwits, this other social network, where we can directly observe the messages that investors are sending about different stocks and their optimism, their bullishness or bearishness about those stocks. And to measure attention, we look at Google searches about different stocks, and we look at household trading records to look at how people trade and the profitability of their trades as news spreads through the social network. So this slide is about our contributions relative to different previous important research in the field, but for reasons of time, I'm going to jump forward to the data on the basic social network data, which is from Facebook, and Bailey et al., a few lines down there, developed the social connected, or do early research on Facebook's social connectedness index. So Facebook is the world's largest online social networking service. 2/3 of US adults use it. So this is rather highly representative data on social networks because it's just so vastly heavily used. 70% of US adults use it daily. It covers a wide range of demographic groups. So SCI is a measure of social connectedness that is between different counties, which is based on the number of friendship links between people in the different counties. So we can measure some counties as being highly socially connected, others are much less socially connected. And so we can look then at the SCI, the social connectedness index in the county of a firm's headquarters, and that will tell us how socially connected a particular firm is. So some firms are much more heavily connected than others. And then we can measure the centrality in the social network of the firm based on its SCI. Now, centrality in a social network can be measured in a variety of mathematical ways. The simplest is called just degree centrality, where one measures how many people are you connected to. Okay, very simple. It turns out there are many legitimate measures, but maybe the most popular measure is eigenvector centrality, which takes into account not just how many people am I connected to, but how many are they connected to. And in turn, how many are those second degree neighbors connected to, and so on off to infinity. So we use that, but our results are robust to using other measures of social centrality. And when we switch to StockTwits data, we have alternative measures of the social networks, and this provides us with some further kind of validation of the validity of the results. So here's a picture of the eigenvector centrality of different US counties. The darker counties are much more socially connected than the light color counties. And social connectedness is positively correlated with population density. So this is a traditional finding in social psychology, that people in areas with more population density tend to have more acquaintances, more social interactions, negatively associated with age, and I won't go through further. Other variables, we look at US common stocks, we measure earnings surprises, we need the location of headquarters of the firms, we need to measure stock returns or abnormal stock return performance, abnormal volume. We have a slew of relevant controls, firm characteristics. I won't mention all of them, but earnings persistence we need to control for, because the degree of persistence of earnings turns out to be related to post-earnings announcement drift, so we want to control for that in looking at whether social network centrality affects stock return predictability, and how visible the firm is. So, for example, its advertising expenses affects its visibility to retail investors, and whether the stock tends to be held by retail investors. Announcement, we control for relevant characteristics of the earnings announcement, relevant characteristics of the county in which the firm is based. So demographics, population density, and so forth. And we have seasonality dummies. So here's a basic result of our finding, is that social interactions facilitate the dissemination of information. And so here we're looking at the dissemination of news about earnings surprises. And so we're looking at, first in the left, CAR 01, that's the announcement date, cumulative abnormal return, right around the date of the earnings announcement. So this is the immediate reaction to the earnings news. And we then are looking to this immediate reaction to the earnings news will have some sensitivity to the earnings surprise, which is the SUE, S-U-E. But if you look at that SUE times CEN, that's interacting it with the network centrality of the firm. So that's seeing whether the sensitivity of the immediate price reaction to the earnings surprise becomes greater if the firm is more centrally located. And the answer is yes. If you look at the red row, that on the left three columns, you can see a significantly higher sensitivity of stock returns to news when the firm is more central. Okay, so consistent with this idea that the news is being disseminated socially. So in particular, if we move from the first decile to the 10th decile, higher increase in centrality across firms, then the immediate response to news is greater by 28%. That is, the sensitivity of return to the earnings news is greater by 28%. And correspondingly, the post-earnings announcement drift is weaker when the centrality is greater. So it seems that the news is being incorporated more rapidly for more central firms, and therefore there's less need for later correction. So the post-earnings announcement drift is weaker. So this is relevant in practice, right? We want to understand how to predict returns, and for portfolio strategies, and network centrality turns out to be relevant for doing that. So all this looks pretty favorable, that this is making the market more efficient, right? It's making high centrality look like a good thing. Let's go on to abnormal trading volume. And consistent with past papers that have looked at the effect of earnings news on trading volume, we have a regression of log volume on the absolute value of the earnings surprise. So the bigger the absolute surprise, probably, merci beaucoup. we have a greater sensitivity, we have that volume is sensitive to the size of the surprise, but we're also bringing centrality into that to see if that sensitivity is greater when the centrality is high. Notice since we have log volume, oh, it came back even better. So because we have log volume, this is really an interaction regression. And the positive coefficients on centrality indicate that volume is higher. Magic. Volume is higher. The volume sensitivity to absolute earnings news is higher when the centrality is higher, both in the short run, but also in the long run. Okay, so we can see then that on the one hand, when it comes to returns, you have the returns being more sensitive to, let's say, good news. So the returns are more sensitive immediately, which makes them less sensitive later. But when it comes to volume, the volume is more sensitive immediately, and the volume is more sensitive later. So the dynamics of prices is different from the dynamics of volumes. And this is consistent with what we call the social churning hypothesis, that you have these social interactions that are spreading news to more and more people. That's causing prices to become more efficient more quickly. But at the same time, you have individuals who are making plenty of mistakes, and they're trading back and forth with each other. These are, to a large extent, idiosyncratic mistakes, so that's not interfering with price efficiency, but it is creating a lot of inefficient trading where investors are taking bets back and forth with each other, and they keep switching their behavior as information spreads from person to person. So volatility and volume persistence. So here we use a standard time series model for measuring this. I won't go into details of the exact structure of the model, but these Ds, these columns, are measures of persistence. And what you can see is that an absolute value of R there, that's basically return volatility or something very closely akin to it. So you can see that return volatility becomes less persistent when you have greater centrality in the social network. And so the return volatility is happening much more early and then dying off, whereas the volume is becoming more persistent. That the volume is, you're getting extra volume from the high social connectedness, but it's becoming more persistent as well. So I've given a preview of the social churning hypothesis, and so I'm not going to talk through this since I basically have before. But again, in brief, the basic point is that high social connectedness spread the information around really quickly, prices become more efficient. But on the other hand, that doesn't mean each individual is becoming a smarter player. Some individuals are getting the earnings news faster and misreacting to it. Some investors are not yet getting the earnings news and they suddenly get it. And so this shift in beliefs and shifts in transmission of biases across investors is leading to continual churning over time for a longer period of time. So so I should move on. So as a way of validating or evaluating whether these results are really meaningful is to look at a different social network. And so StockTwits is a leading investor-oriented social media platform. It's basically like the former Twitter, except that it focuses on stock investing. And we can have measures of investor responses to earnings announcements, which are in some ways more granular, or because we can look at the number of new messages about a particular stock, both initial messages about a stock in a thread, which can proxy for the number of newly informed investors, and reply messages, which one could view as somewhat like volume responses. This is people reacting to someone else brought the information to bear, and then other people are reacting to it. And we can directly measure disagreement as the standard deviation of the sentiments about the stock of different messages. We also measure influencers, which is a different kind of measure of social connectedness when it is tweeted about by influencers. And so what we see is that when the firm is more central, we get a more immediate increase in abnormal new messages. So the information getting incorporated more quickly, but then we also have a more precipitous drop in the number of new messages. Okay, so that fits with the market becoming more efficient in terms of transmitting information. And the abnormal reply messages, on the other hand, those increase more when it's more connected, but it remains high later on. So this fits with the social churning that people are continually replying more to the same news has gotten out there, but people are continually reacting to it for long periods of time. And there's also disagreement, which is higher when there's greater social connectedness, and that disagreement is more persistent. So again, it seems that there's churning in beliefs, and there's churning in disagreement. So we argue that this is very consistent with the broad message that we arrived at with the Facebook data. We look at household trading, and again, greater social, here we have a different measure of connectedness because we want to look at the extent to which the county of the investor is connected to the county of the firm, and we find that greater social connectedness is inducing greater trading by the investors, and performance is of great interest, right? Is this just more information is getting spread more rapidly and therefore investors are doing better? Or at least that investors are breaking even because the market's becoming more efficient? And the answer is kind of no, that the more connected investors are to the firm, the worse is their net performance. And the reason their performance is worse is almost entirely because they're incurring greater trading costs, which includes both spreads and brokerage fees in this earlier era when brokerage fees were more substantial. So investors seem to be trading more aggressively, more actively when the firm is when they're more socially connected to the firm, but they're not gaining at all thereby. It seems to be more of a behavioral thing. So we have a double-edged blade that the greater social connectedness is making markets more efficient, but it's also causing investors to trade more aggressively and to lose thereby. Additional results, which I really won't get into, but to try to identify causality, we look at Hurricane Sandy, which interfered with the communication on the social network, at least arguably. Counties that were influenced by Hurricane Sandy, people had other things on their minds as compared with a firm's latest stock announcement. And our test is not about the people based in the areas in Hurricane Sandy, but people based in areas unaffected by Sandy, but that had social links to people in the Sandy areas. We find results that are compatible. To conclude, we argue that social interactions among investors affect the transmission of beliefs, the creation of disagreement, and the efficiency of stock prices in response to earnings announcements. And so on the one hand, greater social connectedness of the firm is helping to get earnings news be incorporated into price more rapidly, but on the other hand, it's also causing greater transmission of behavioral bias across investors so that you get idiosyncratic kind of mistakes that investors are making, mistakes that are inducing disagreements where investors are trading more against each other, and they're also more persistent in disagreeing with each other, and who believes what is continually shifting over time more, causing greater social churning, more persistent volume of trade. We see this reflected not just in volume of trade and in prices, but in the messages that are sent in social media, by the tone of those messages in social media, where we can measure how much people are disagreeing with each other. And we're seeing that this hurts investor performance. So just in closing, there are further avenues of research that deserve to be pursued. One example being that there's other public news to consider, not just earnings announcements. There's also the arrival of private information, misinformation, or so-called fake news. So there are many directions of further research, including effects on real economic outcomes as compared with just financial market trading. So thank you very much.
There is one question. Maybe we can take two, three. Mr., I think you are the first.
Hi, I have 3 short related questions about social networks. Are you claiming that social networks are an opportunity for retail trading? First question.
Let me go one at a time for us of memory constraints. So did you say retail trading in options markets?
No, I mean, using social networks as a platform, as a leverage.
Could you speak more slowly? I need to absorb better.
Okay. Are you claiming that social networks can be a leverage or an opportunity for retail trading?
There's a little bit of distortion from the microphone, so maybe hold it further. I just didn't hear the words.
Okay. Are you claiming that social networks are a leverage or opportunity for retail trading?
Are social networks a leverage or opportunity for retail trading?
Yeah, related to
yes, they are indeed, and we saw this, for example, in the GameStop bubble with the meme stocks, where the platform of Wall Street bets on Reddit caused retail investors to coordinate with each other to manipulate the market and cause bubbles in certain meme stocks.
And as such, self-referential or self-realizing prophecies, as everyone believes in the same insight or information, their coordination becomes a market reality.
Indeed.
Self-referential
there
mechanism.
Was a positive feedback process, I agree.
So, last question, short. Then how the noise found in social networks compare with someone just watching Bloomberg TV in front of him?
How does knowledge and
Yeah, I mean the noise in social networks, how it is different, the noise from social networks comparing with someone watching Bloomberg TV on a Sunday morning?
I think that's a central issue, that it could be that we all together watch Bloomberg and maybe there's some bias that is disseminated by the speaker, and so we're all influenced at the same time, and then that causes a mispricing that later gets corrected. On the other hand, in the social network, you can get biases that come from biases in the transmission process. So for example, suppose I trade on the stock and that I'm more likely to talk about that stock if I made money and it went up than if I lost money and it went down. Then what happens is that after a price run-up, a lot of people are going to be talking favorably about the stock and reporting that it's a great stock. And so there's an example where it's not just kind of random noise that somebody formed an opinion that was too optimistic or pessimistic. Instead, there are systematic dynamics which are occurring as a function of past events. And so you get things that are predictable based on the structure of the social network and from the transmission biases. And so once again, the size of the effect will depend on how many people are currently holding the stock, because those are like viral super spreaders, and it will depend on what is the bias in transmission. Do I talk about gains, not losses, or do I have some other kind of bias?
Thank you. So maybe one last question. Marie, you censor me, but I think we are a bit late, so one last question.
How do you take into account the fact that most of the trading volume is done by robots who do not have social networks?
Well, I think many people in this room know more than me about the robo trading and prevalence, but from my viewpoint, there's a tremendous amount of evidence that retail investors still have an influence on financial market volume and prices. That meme stock episode, again, is one very special kind of illustration of that, where we saw very directly that communication by retail investors had a huge effect on certain smaller stocks. But there's been recent writings by practitioners, I think it may have been Cliff Asness, arguing that retail investors in recent decades have become even more important in the past rather than less important because of the rise of social media and certain other factors.
Thank you. Thanks a lot, Professor. And please join me in clapping our hands. Thank you.
Thank you.
Thanks a lot.
Thank you.
So I'm welcoming on stage Charles-Albert Lehal, amongst other dear panelists, on a panel which actually, and this is the beauty of the program, is very linked to the conversation. Yes. It's a bit like the natural steps. So we've been discussing investment decisions, and now we'll be discussing new retail trading models. So the floor is yours, Charles-Albert.
Thank you very much, Emilie. I will talk in these ones. No? Oh, that's okay. So let me introduce you our panelists. So we have Philippe Guillot, but who replaced Alexandra Givry. So sorry to have only men on stage. It was not initially planned. But thank you nevertheless, Philippe, to have replaced her so nicely. And Philippe is the director of markets at the French regulator, AMF. Paul Besson from Euronext, and we've got Éric Retien from Kepler Chevreux. And myself, I'm Charles-Albert Lehal, from École Polytechnique. And so we will continue the discussion on price formation and retail. And therefore, as an introduction, I have to remind us what you just told us, that indeed what is moving price is information. And information is propagated by a lot of different ways. So you can have a first view saying that, when there is information, people take time to digest, and they digest with a different speed depending on their own characteristics. So for these reasons, the fact that price move when information is correctly digested, it plays in favor of having a wide diversity of persons taking place to price formation, so that when they agree, when there is an agreement, the price is moving permanently and the price is going where it should be. On the other hand, if you look at the price formation from the perspective of a market maker, he or she would prefer to face only one type of investor, one type of client, to understand better what is the market maker will tell the toxicity of this counterparty, but indeed the level of information, to make a different price depending with whom you trade. So we see quite naturally that there are two ways to see the market, maybe both efficient, or if you ask to a generic investor or to an economist, maybe he or she will tell you it's more efficient to have a wide diversity of people with a wide diversity of viewpoints to take decisions on markets and to trade together and to accept that the price will move or not. But from the perspective of a market maker, the story is completely different. And moreover, it's not only a matter of one being wrong or right. It's more that you could see that saying that instantaneously, if you wake up discovering a market, you probably prefer that it's immediately optimal, having everyone in the same place. But if you consider the market as habits, that market makers slowly learn with whom they trade, this idea of memory that is symmetric. As a market maker, I would like to know my counterparty, but as a counterparty, maybe I accept to give money to the market maker so that he or she will be there in a few weeks to provide me liquidity. So the story is not as simple as just saying everyone should trade in the same pool of liquidity, or we should have very specific channels to convey different kinds of investors. And it is what we will talk about today, I mean, at this roundtable. New practices, you will tell me and us if it's really new, but the fact that retail flows, especially in the US, and in Europe the story is quite more fragmented, retail flow are directly channeled out of exchanges and are preempted by companies who are specialists and are paying to get this flow. Is it a new practice? Is it something that is part of the innovation that the Risk Forum is trying to promote? Or is it something that research to document to help us to maybe prevent and to help the regulator and the regulatory authority to say that things should be different? So I will stop talking too much and ask to each of you, maybe to start with, how do you see the main factors that put or drove us in this current situation, according to each of your viewpoints? So maybe Philippe, if you want to start.
So, from my experience, and I'm going to talk about the difference between French market and other European markets. French markets are starting from a different point. Up to something like 20 years ago, we had the concentration rule where all flows had to go to the centralized exchange. And this creates habits and strategies that were not the same on other markets. If you look, for instance, at Germany, all the flows were concentrated by intermediaries to something they called the Casa price. And in the UK, for instance, all the flows were captured ex ante by market makers. So we started from different market behaviors, but also with different retail proportions. Retail flow in France, because of many different reasons, is around 4 to 5% of the overall market volume, while in countries like Italy it can be 20%, and in the US up to a quarter or a third of the volume. Obviously, all that depending on the different liquidity of the stock. The overall proportion of retail flow is much bigger on penny stocks and small and micro caps than on blue chips, obviously. And so, with the firstly advent of MiFID, so new rules, and the advent of digitalizations and the change in behavior of the market, we have seen more and more flow being captured ex ante. And we have seen changes in the price formation process. I would like to stress out one thing. We are talking more and more about bilateral trading. I just want to insist on the fact that every trading is bilateral. You always have one buyer and one seller. So every trade is ultimately bilateral. So we shouldn't talk about bilateral trading, but bilateral or multilateral price formation process. And what really matters is the multilaterality of the price formation process. And in that, you should consider that as Charles rightly said, a variety of investors who are all buying or selling for legitimate reasons on a different size and at different time horizons. And so the markets are made to have that place where everybody meets, where the price formation process is as multilateral as possible.
Thank you, Philippe. Paul, your take on that?
Yes, thank you, Charles. Yeah, so on the market side, multilateral venues like Euronext, what we saw is that we saw some new venues in Europe offering, for example, some free executions or almost free execution just for retail investors. So meaning new MTFs coming in, and where a new concept that was generalized, it's about, we speak a lot about market fragmentation, less so often about market segmentation, where markets are segmented. So we saw new MTFs, exchanges arriving on the market, just dedicated on retail, using often a reference price that were determined externally. But this is something we saw, so we had to develop like new offer in that space. So that is what we saw.
Yes, I'll speak from a practitioner point of view, and what we saw, because I was with an online broker in the 2000s and so on. Basically, the trading model, because this is the topic, was exactly the same whether you were an online broker or a traditional bank. You went to the primary market, and then you went through the MTFs, and you tried to provide the best price. What we've seen more recently, and it's coming in Europe from Germany, is that SIs, systematic internalizers, which have the ability to pay for the order flow, PFOF, means that the new online players are now very aggressive on pricing because basically they are subsidized by the SIs. So that shift is quite recent. And, you know, from a French point of view, when you see Trade Republic and the likes, they are the real disruptors. The traditional online brokers, which existed 15, 20 years ago, had the same model as traditional banks. Now it's changing with the SI and PFOF, basically.
Thank you. Yes, so PFOP that we will use is a payment for order flow. So referring to the fact that some some intermediaries are only offering trading for retail and then are selling this flow to very specific market participants, and this flow will not interact with, randomly or at the pace that they could have reached the market with other market participants. So this aspect, how do you see, Philippe, this playing in terms of, what is the role of preempting part of this flow? Maybe if one of you want also to talk about how this flow, the retail flow, complements or not the institutional flow, and maybe part of the picture is missing if you prevent this flow to reach markets.
It's a matter of informational content. The information content of a retail order is fairly low, which means that when you trade on a market, you've got two ways of trading. Whether you know something and you think it's important to act immediately, and then you cross the spread, you send an aggressive order, or you expect that the market will not change, you put a passive order, and you expect to trade against somebody who is willing to have immediate trading, but without knowing more than you. What is absolutely worse is to put a passive orders and being hit by somebody more knowledgeable than you. And so it's in that mix that you really have the key elements. If you subtract from that flow the less informed order, the overall toxicity of the flow increases, which means you're more likely to being hit when you put a passive order by somebody who's got more information than you do, or who can react more quickly than you do. In that sense, it reduces the incentive of passive orders, so it may not have an impact on the spread itself, but it may have an impact on the amount of shares you are willing to commit to be present on the spread. So it will have an impact in both terms of spread and in both terms of liquidity available at the best time. And so in that situation, people who will commit liquidity on the touch are the people who are confident in their capability of reacting faster than the others or knowing better than the others. And so if you are, I would say, mid-range player, not that specialized player, and you put orders on passive orders, you increase the risks of adverse selection. So this is for retail flow, but it's not only for only for retail flow. If you look at the ladder of information, you've got orders, for instance, that have a very limited informational contents, which are VWAP orders. VWAP orders, you want to execute them at regular intervals, and you need to complete your order by the end of the day. So far, these are orders that have been that brokers have tried to internalize. And what brokers are doing by internalizing those orders is they send back on the market the portion they haven't been able to internalize. But because you've got very high number of intermediaries, this is a fairly inefficient process. You cross a very limited portion of your orders at VWAP, and you send the maximum of those orders on the market. We are now seeing in Europe so-called trajectory crossing orders arriving onto the market. This is something that has been authorized in the UK by the FCA, and so this is something, this VWAP crossing of orders is now authorized at the trading venue level. And so something that was very inefficient when run by the brokers might become much more efficient from the point of view of the trading venue in the terms of crossing rate, but very less efficient in terms of price formation process. So I've had the hint that there are some people doing some research in the assistance. If there's something that can be of interest for you at some point, you may look at the different evolution between European markets and the UK market because of those rules in the coming years. That might be interesting to see, to look at that particular evolution. But as a regulator, my feeling is you should do whatever is possible to make sure that the price formation process combines a maximum of different participants. Just like when you're looking at diversity, biodiversity, if you're talking about ecology, if you want a system that is viable, diversity needs to be at its high.
Thank you, Philippe. So yes, Philippe covered rightly like one part of the equation that was the question was raised by Charles Albert, meaning what happens if you remove the best orders, the one that contain the least informational content in the market, meaning it would deprive the market from its best order, and thereby you will have more toxicity probably in the market, and something that we've seen like some papers in the US about it. The problem is that on the other way around, how could you prevent then people that have and benefit, they know their trades worth more, how could you prevent them from trading at a better price? Just like, for example, if you take an insurance, if you drive a car, if you whatever, take less risk than others, why would you pay more for many insurances been segmented by participants type since many years, okay? How could it be prevented? Why could it be prevented? It's a legitimate question when you have a retail guy. So we could say that if your flow is better, less informed, you could have a better price. For example, that's a normal and it's a fair assessment. So either on this, you could say, we will give you a better price, meaning you have special order types. For example, it's a solution that we've developed at Euronext, where we have a special market types, order types that are, for example, protected, meaning the market maker, by using these orders, will only interact against a retail order, meaning he has got much less risk, and thereby like 10% of these orders are better limits than normal orders. So it's one way to do it on exchange, as we do, or the other way around is to say, guess what? You will have exactly the same price as everyone else, but the margin will not be paid to the retail guy, but to the intermediary, paying the broker, but the broker will not pay its end client with a better price, but the money will go to the broker's pocket. So this is another possibility as people can choose, but to me, I'm not a regulator. I think best execution should be more strictly defined and better defined, meaning you have to do the best given the quality of the flow you are executing. It's not the same thing as if I am executing anonymous flow that could be toxic on exchange anonymously, or if I know I will tell this is Eric's flow, it's really retail behind, is really kind. So every market maker will tell me I can improve my price if I trade against Eric. So for us as a multilateral exchange, we prefer to pass on the price improvement to Eric and client rather than giving him some money in his pocket, and him just feeling the normal price that everyone would get. That's our point of view. Eric, it's for you now.
Way too technical for me, and I will not, comment on what was said. All I can say is that from a retail investor's perspective, price improvement counts for very little in the overall consideration that he has when trading, because basically what the retail investor is looking at is the cost of trading. And when we say cost of trading, we look at the pricing. Okay, maybe it's not the best price, but we look at the cost of trading and so on. And what the new models are right now offering to the retail clients, thanks to PFOF, is subsidized trading costs. And price improvement in that equation is not the main consideration of a retail investor who doesn't really understand price formation, to be honest. Aggressive, passive, those notions are completely irrelevant for a retail investor.
You want to react, Philippe?
Yes, it's just a matter of shopping. Is to do your shopping, you're very happy to go to the supermarket, but you're very happy to go at the convenience store, open 24/7 just next to your house, because sometimes you really need to go to that convenience store. But when you go to that convenience store, you are paying the service. So what you are paying is you've got less diversity of products and spreads are wider. At the moment, when what people are trying to make us believe on going through those brokers is that the convenience store round the corner is cheaper than the supermarket. Obviously, this is not the supermarket we've known a few years ago, because the supermarket itself has changed. Because the supermarket now understands the pressure of being open 24/7 or to extend its trading hours, to be open on Sundays and so on, which means the overall prices of the overall offer of the supermarket has downgraded, which means that whenever you needed to go to the cashier and you had plenty of cashiers, you've got less cashiers, you need to do the checkout yourself and so on and so on. So the overall offer of the supermarket has downgraded. But if you take off all the retail flow from the supermarket, the offer will even more be downgraded. So as a regulator, we need to pay attention to that. And I totally understand that people are competing, that there is competition between convenience stores and supermarkets, that to compete, they need to compete on services, that's order types, and tariffs. But at some point, we need to pay attention to the global equilibrium and to the global good, rather than leaving all the market forces being acting freely together.
Yeah, so what I keep from this part of the discussion is that there is a lot of research to be done on best execution in general. How to qualify that, because we talked about the overall cost, as you said, Eric, price improvement for retail, and that's completely different to have a price improvement when you trade once a month or when you trade several times a day because you are an institutional. So that's clear that even if it's in bips, in terms of dollars, the amount is not the same at all.
And size of the order.
And the size is also, so in terms of dollars, it's not the same. And so there is this aspect of just measuring, depending on how frequently you go to market. The second aspect is taking into account this idea of duration that the analogy of Philippe mentioned with this convenience store. Usually in the classical theory, you agree to pay more the market maker because you pay so that he will be there when you will need it in condition of market stress, for instance. And what we saw, for instance, during the flash crashes, is that during the flash crashes, these flows have been immediately released to the market and not kept. So the second acceleration in the flash crash was about this internalizer releasing all these retail flow immediately in the market at the worst moment somehow. So but there is this temporal aspect in best execution that is also important. Maybe because we are slowly approaching the end of the session, if you've got, I can open the question to the room. If you've got questions related to retail and retail order flow or centralized trading, think about it, and in a few seconds I will give you the mic. Waiting for questions to arrive. There is a maybe I should play the role of the market maker, because I think you are too much coordinate in a sense, and that's true that this kind of players are somehow allowing, by paying for order flow, the neo brokers to be almost free for the investor. So there is this aspect. If it's not on the total cost or improvement, at least it may attract a flow of retail that will never pay the standard brokerage cost to trade. So it may be a positive aspect of having this positive collusion between neo brokers and market makers.
No, but what we are seeing, and this is something we publish papers on our website, Observatoire de l'Épargne and so on, so you can find them on our website. What we are seeing is the profile of the new investors, and we've had lots of new investors arriving in the coming years, is completely different. And the profile of those investors that are being dragged and driven to the market by the new offers of neo-brokers is dramatically different. As an example, the traditional brick-and-mortar bank, its retail flow will probably trade in an average size of just below 1,000 euros, and they will trade 5 to 6 times a year. The trade, the neo-broker trade is of a size that is 10 to 50 times smaller, but they will trade every month or every year at regular intervals and on very smaller number of issues. And also that's why when we're talking about PFOF still exists in some countries, but when you trade on new offerings like fractional shares or fractional ETFs, it's also a way to, I would say, hide the margin that was into the PFOF in the products that you are offering to the clients. But on the other hand, as Charles rightly said, it brings new investors to the market. So at some point, what we need to do is, on those investors that have a very healthy investment pattern, like putting a little bit of money every month and so on, at some point, we need to make sure we offer them something else, and that as time goes by, that they're also moving to different trading habits. But I'm not, this is very good for them. But at the moment, it's just as if they were doing all their shopping at the convenience store. So I'm not saying I'm against convenience store. They give a service. I'm not pro supermarkets. They also give a service. Just like I was saying that on the markets, we need a diversity of people. For the markets, we need a diversity of offers. And what I do not want is the convenience stores or the supermarkets to gain all market share and get rid of the other, is to make sure that everybody can cohabit smoothly.
Thank you, Philippe. So on ourselves, for sure, we presented initially the two possibilities. Either you pay payment for order flow, meaning even if your flow is much better, you get the same price as everyone, but the margin comes to the broker's pocket, payment for order flow, or the other way around, saying the improvement is fully passed on to the retail investor and not to the broker. But they are also in a multilateral fashion, like we do, for example, at Euronext, but also Deutsche Börse or NYSE in the past, same kind of solution. You can have protected orders that are priced more expensively for the market maker, so that the market maker will not fully improve all the time, but will charge more the market maker and less the broker, so that everyone can be happy, because we don't, I mean, the sensitivity of the final client to either the fees or the price improvement is not us to decide, but we can model in a multilateral fashion this kind to make coincide this kind of preferences. But it's still better, for one last comment, is that when it's on exchange and it's multilaterally done, with everyone knowing of the quality of the flow, then you have a real-time competition between market makers that are equally cognizant of the nature of the flows they are facing. So the competition is better, stricter, than if you're just delegating and selling all your flows with no competition to one single market maker. So it's a bit different.
Eric, do you want to conclude?
Yes, I would say, I see the points that have just been made, but we as brokers, we don't take a view whether we should go on the primary market, on MTFs or on SI. Our role is to offer, whatever the clients want, and as an intermediary, we can plug, one way or the other, so that, in effect, we can offer both worlds. The only thing I would say is we're not in a level playing field as far as PFOF is concerned, and that is distorting, competition on Europe.
Okay. Do you have a question?
So arguably, the convenience of convenience stores makes some people worse off. So having 24/7 access to candy, tobacco, and sugary drinks may be harmful to some people. And my question is, should this be a regulatory consideration?
Today, when you go to your convenience store at 3 in the morning, you are ready to pay the premium. And the question is, will people have the understanding of the premium that is being charged to them? I'm not sure about it. Secondly, you know that volatility in the market can happen at any time, which means you probably, and the price formation process is something that is very elastic. And with digitally connected markets, the transmission of shock is immediate. And then one of the biggest shock absorbers you have on the market is dissemination of the news on different asset classes by arbitrage through let's say, Eurostoxx 50, S&P 500, but also bonds, but also from time to time commodities, and so on and so on. So if you trade in the wee hours of the night, it's very likely that your shock absorbers won't be there anymore, and that the shock dissemination will create some frenzy activities that is not necessarily desirable. So in that, what really matters are, if you do not have the shock absorbers because everybody is in the market, then you need to have volatility interruptions, just to make sure you give people time to wake up, have a cup of coffee, and realize what happened. And so, yes, this is a concern. And maybe also to try to conclude on a different note, at some point, if you really want to have a convenience store that is profitable in the middle of the night, what you have to do is sell cigarettes and alcohol.
Thank you for this toxicity analysis. Maybe I will take a last question, if there is one. Otherwise, I'll propose to thank all the panelists and to go to the next session.